I'm 71 years old, and 6 months ago I almost lost $47,000 of my retirement savings because I ignored 3 warning signs that I didn't even know I was supposed to be looking for. Not because of a market crash, not because of bad investments, because of a federal tax provision that's been on the books since 2019, but that most retirees have never heard of until it's too late. My neighbor Frank, he wasn't as lucky as me. Frank is 74, worked for the post office for 38 years, saved diligently, had about $340,000 in his IRA when he retired. Last year, the IRS put a lien on his entire account, froze it, every penny. He can't access his own money. He's been fighting it for 14 months. He spent $22,000 on lawyers, and he's probably going to lose at least half of what he saved because he ignored 2 letters and missed 1 deadline. 2 letters, 1 deadline, 38 years of savings gone. And here's the part that should terrify you. Frank did everything right. He paid his taxes. He filed on time. He wasn't trying to cheat anyone. He just didn't understand a rule change that happened in 2019. Didn't recognize the warning signs when they showed up. And now he's 74 years old, fighting the federal government for access to his own retirement money. This isn't a political video. I don't care who you voted for. I don't care what you think about tax policy. I care that there are 5 specific warning signs that if you ignore them after age 65, you could lose everything you've spent your life building. And most people have no idea these signs even exist until they get the letter that says their retirement account has been seized. I'm going to tell you what those 5 signs are. I'm going to explain exactly what's happening and why it's legal. I'm going to show you how to check if you're at risk. And I'm going to give you the exact steps I took to protect my money when I discovered I had 3 of these 5 warning signs. But first, let me tell you about Frank, because Frank's story is the reason I started digging into this. And what I found made me lose sleep for a week. Frank retired in 2020. Good timing, he thought, right before everything went crazy with the pandemic. He had his pension from the post office, Social Security, and his IRA. He was comfortable, not rich, but comfortable. He and his wife, Martha, were planning to travel, see the grandkids more, do the things they'd put off for 40 years. In 2022, Frank got a letter from the IRS. It was about his required minimum distribution, RMD. If you're over 73, you know what this is. The government requires you to start withdrawing money from your tax-deferred retirement accounts and paying taxes on it. You can't just leave it in there forever. Frank had taken his RMD. He was sure he had. He remembered doing it, but the letter said he hadn't taken enough. Said he owed a penalty, 50% of what he should have withdrawn but didn't. Frank looked at his records. He had withdrawn money, but apparently he'd calculated it wrong. He'd used the balance from the wrong year, made an honest mistake. The kind of mistake that's easy to make when you're dealing with IRS tables and life expectancy calculations and multiple retirement accounts. The penalty, $8,400. Frank was upset, but he paid it. Thought that was the end of it. It wasn't. 6 months later, another letter. This one said he owed additional taxes on something called an excess accumulation. Frank had no idea what that meant. The letter was full of tax code references and calculations he couldn't follow. It said he owed $3,200 more. Frank thought it was a mistake. He'd already paid the penalty. He threw the letter in a drawer and figured he'd deal with it later. Maybe call his accountant after tax season when the guy wasn't so busy. That was his first mistake. 3 months after that, a third letter. This one wasn't asking. This one was informing. The IRS had placed a lien on his IRA, all $340,000 of it, frozen until he paid not just the $3,200, but additional penalties for not responding to the previous letter, plus interest. Total amount due, $11,800. But here's the nightmare part. Even though he only owed $11,800, they'd frozen all $340,000. And the rules say that if you have a federal tax lien on a retirement account, you can't access that account until the lien is resolved. Even if you want to withdraw money to pay the lien, you can't because the account is frozen. It's a catch-22. You owe money. Your money is frozen. You can't access your money to pay what you owe. So penalties and interest keep accumulating while you fight through the bureaucratic process of getting the lien released. Frank called the IRS, got transferred 7 times, spoke to people who couldn't help him, was told he needed to file forms, needed to wait for reviews, needed to provide documentation going back 5 years. He hired a tax attorney. That's when he found out about the provision that changed in 2019, something called the SECURE Act. It changed a bunch of rules about retirement accounts. Most people heard about it because it raised the RMD age from 70 and a half to 72 and then to 73. But buried in that law was another change. It gave the IRS expanded authority to place liens on retirement accounts for unpaid tax debts related to those accounts. And it shortened the timeline for how long you have to respond to notices before they can freeze your account. Before 2019, you'd get multiple notices over 12 to 18 months before serious action. After 2019, you get 2 notices, 90 days total, then they can freeze everything. Frank didn't know any of this. The letters looked like standard IRS mail. He got so much mail from insurance companies and Medicare and investment firms that he didn't prioritize 2 letters from the IRS about what seemed like a resolved issue. Now he's been fighting for 14 months. He's hired lawyers. He's filed appeals. He's proven that the original penalty was wrong, that he doesn't owe most of what they claimed, and he'll probably win eventually. But eventually is the problem. He's 74 years old. His retirement account has been frozen for over a year. He can't access it, can't withdraw from it, can't use it to live. He's surviving on Social Security and his pension. He's had to cancel trips, delay medical procedures because he can't afford the copays. His wife Martha cries every time we talk about it because they did everything right, and this is still happening to them. That's when I started investigating, because if it could happen to Frank, it could happen to me. It could happen to anyone. I spent 3 weeks researching, read the SECURE Act, talked to my financial advisor, talked to a tax attorney, read IRS publications until my eyes crossed, and I found something that made my blood run cold. There are 5 specific warning signs that indicate you're at high risk of having your retirement account frozen or seized by the IRS, and I had 3 of them, 3 out of 5. I'd been walking around thinking I was fine, thinking I understood my retirement situation, while I was actually one mistake away from being in Frank's position. So let me tell you what these 5 warning signs are, because if you have even one of them, you need to take action this week, not next month, this week. Warning sign number 1, you have multiple retirement accounts from different employers and you're over 73. This seems innocent. Most people who've worked multiple jobs have this. I have 3 retirement accounts, 1 401k from my first job, 1 from my second career, and 1 IRA I rolled another 401k into. Here's why this is dangerous. Each account has its own RMD calculation. And if you have accounts at different institutions, they don't talk to each other. You're responsible for calculating the correct total RMD across all accounts and making sure you withdraw at least that much. Most people don't know this. They think each account calculates it automatically. Some do. But if you have an old 401k that you never rolled over, or an IRA at a small brokerage, they might not calculate it correctly. Or they might calculate it based only on that account without knowing about your other accounts. If you don't withdraw enough total, you owe the 50% penalty, even if it's an honest mistake, even if each individual account told you you were fine. I had this problem. I had 3 accounts. I was taking RMDs from 2 of them. I had completely forgotten about the third one because it only had $18,000 in it. Small enough that I wasn't thinking about it, big enough that the IRS cared. Warning sign number 2, you turned 73 in the last 2 years and you're not absolutely certain you calculated your first RMD correctly. Your first RMD is the most likely one to be wrong because the rules changed recently, because you're new to the process, because the calculation is complicated. Here's what most people don't know. Your first RMD can be delayed until April 1st of the year after you turn 73. But if you delay it, you have to take 2 RMDs in that second year. Your delayed first one plus your current one. A lot of people delay the first one, take it in April of the following year, and then forget they also need to take the current year's RMD by December 31st of that same year. They think they're done because they just took one, but they needed to take 2. This was Frank's mistake. He delayed his first RMD, took it in April 2022, thought he was good, didn't take his 2022 RMD until 2023. The IRS said he'd failed to take his 2022 RMD on time. 50% penalty on the amount he should have withdrawn but didn't. Warning sign number 3. You've received any letter from the IRS in the last 12 months about your retirement accounts, even if you thought you resolved it. This is the big one. This is the one that gets people. The IRS sends notices, CP notices. They have numbers CP 2000, CP 14, CP 501. They look like junk mail. They're printed on cheap paper. They don't look urgent. But these notices are part of a legal timeline. When you receive one, you have a specific amount of time to respond, usually 30 days. If you don't respond, they send a second notice. You get another 30 days. If you don't respond to the second notice, they can take action. They can file a lien. They can levy your accounts. They can freeze your retirement money. And here's the cruel part. Responding doesn't mean paying. It means formally responding, filing the right forms, disputing if you disagree, following the specific procedures outlined in the notice. Most people either ignore the notices because they think they're mistakes, or they pay what's asked without understanding that paying doesn't necessarily close the issue. Sometimes paying the initial amount triggers additional reviews that generate more notices. I got a CP 2000 notice 8 months ago. It said I'd underreported income by $4,800. I looked at my records. I hadn't underreported anything. It was a mistake on their end. They'd counted some income twice. I almost threw the notice away. Almost figured it would sort itself out. But because of what happened to Frank, I didn't. I called the number on the notice, spent 2 hours on hold, got transferred 4 times. Finally spoke to someone who told me I needed to file Form 14039 and send documentation proving the income wasn't underreported. I did it, sent it certified mail, got a letter 6 weeks later saying they'd reviewed it and agreed no additional tax owed. Case closed if I hadn't responded, if I just ignored it like I wanted to. 30 days later, I would have gotten a second notice with penalties added. 30 days after that, they could have placed a lien on my accounts. Over a mistake that was their fault, that I didn't even owe. But because the burden of proof is on me, not them, ignoring it would have been catastrophic. Warning sign. Number 4, you've inherited a retirement account from someone who died after 2019. This is newer and a lot of people don't know about it. The Secure Act changed the rules for inherited IRAs. Used to be, if you inherited an IRA, you could stretch the distributions over your lifetime. Take small amounts each year, let the rest grow tax deferred. After 2019, that changed. Now, if you inherit an IRA from someone who wasn't your spouse, you have to empty the account within 10 years. All of it, withdrawn and taxed. But here's where people get in trouble. You still have to take minimum distributions each year during those 10 years. You can't just wait until year 10 and take it all out. You have to take annual distributions based on a formula. A lot of people don't know this. They inherit an IRA, think they have 10 years to figure it out, don't take any distributions for the first few years, and then get hit with massive penalties for failing to take required distributions. I know a woman who inherited $190,000 from her father in 2020, didn't take any distributions in 2020, 2021, or 2022, thought she had until 2030 to worry about it. Got a letter in 2023 saying she owed $28,500 in penalties for 3 years of missed RMDs. She didn't even know she was supposed to be taking distributions. The brokerage holding the account never told her. The IRS expects you to know the rules. Ignorance isn't a defense. Warning sign number 5. You took an early distribution from a retirement account in the last 3 years, and you're not absolutely certain it was reported correctly. This applies to people who took money out of retirement accounts before age 59 and a half, maybe for a house, maybe for medical expenses, maybe because you lost your job and needed it. There are exceptions that let you avoid the 10% early withdrawal penalty, medical expenses over a certain threshold, first-time home purchase up to $10,000, substantially equal periodic payments. But you have to report these correctly. You have to file the right forms. You have to prove you qualified for the exception. A lot of people take the money, pay the taxes, think they're done. Don't realize they also needed to file Form 5329 to show they qualified for an exception. The IRS looks at their return, sees the distribution, but no Form 5329, assumes they owe the penalty, sends a bill, or worse, they think the brokerage reported it correctly. But the brokerage just reports the distribution. They don't report which exception you're claiming. You have to do that. I took $15,000 out of an IRA in 2021 for medical expenses. Qualified for the medical expense exception. My tax guy filed the right forms. I thought we were good. 2 years later, I get a notice saying I owe a $700 penalty plus interest. They're claiming I didn't qualify for the exception. I dig out my 2021 return. The form is right there, filed correctly. Turns out their computer didn't match something properly. It was a processing error, but I had to prove it, had to send documentation, had to follow their procedures. If I'd ignored that notice, it would have snowballed. $1,500 becomes $2,000 with penalties and interest. Then they send the second notice. Then they can lien my accounts for $2,000, which means freezing $500,000 to collect $2,000. Now, here's what you need to understand. Having one of these warning signs doesn't mean you're definitely going to have your retirement seized, but it means you're at risk. It means you need to be vigilant. Having 3 or more of these signs, you need to take action immediately. Let me tell you what I did when I discovered I had 3 of these 5 warning signs. Step 1, I created a complete retirement account inventory. I listed every retirement account I had, every 401k, every IRA, every pension. I wrote down the institution, the account number, the current balance, and the date I'd last taken a distribution. This took me 3 hours because I had to dig through old files and call 2 different brokerages for account numbers I'd forgotten. But when I was done, I had a complete picture. Turned out I had 4 retirement accounts, not 3. I'd completely forgotten about a small 403B from a teaching job I'd had for 2 years in the 1990s. It had $7,300 in it. I hadn't thought about it in decades. That account was supposed to have RMDs too. I hadn't taken any. I'd been in violation for 2 years without knowing it. Step 2, I hired a CPA who specializes in retirement tax issues, not my regular tax guy. He's fine for basic returns, but this required someone who lives and breathes retirement account rules. I found a CPA through the American Institute of CPA's website, looked for someone who had the personal financial specialist designation, paid him $850 for a comprehensive review of my retirement situation, best $850 I've ever spent. He found the forgotten 403B. He found 2 small errors in how I'd been calculating my RMDs. Nothing that had triggered penalties yet, but if I'd continued the same way, I would have been underpaying within 2 years. He also found that one of my brokerages had been calculating my RMD wrong. They'd been using the wrong life expectancy table. They were telling me to withdraw less than I actually needed to. I'd been following their guidance. Would have been my problem when the IRS caught it. Step 3. I set up a system to track every IRS notice and respond to everything within 7 days. I bought a filing cabinet just for IRS and retirement stuff. Every notice that comes in, it goes in the cabinet. I log it in a spreadsheet. Date received, date responded, confirmation number if I called, tracking number if I mailed something. I respond to everything within 7 days of receiving it. Even if it's clearly a mistake, even if I think it's going to resolve itself, I respond formally in writing with documentation. Since I started doing this 8 months ago, I've received 4 IRS notices. 2 were mistakes on their end. 1 was legitimate, and I owed $340 for an error on my state tax return that affected my federal return. 1 was a notice that they'd processed my response to a previous notice. If I'd ignored any of them, even the ones that were their mistakes, I'd be in Frank's situation right now. Let me give you the specific action steps you need to take this week if you have any of these warning signs. Action item 1. List every retirement account you have, all of them. Go back through old tax returns, old pay stubs. Call every company you've ever worked for that had a 401k. Find every account. Get the current balances. Make sure you know what you have and where it is. If you find an old account you'd forgotten about, call them immediately. Ask if you're supposed to be taking RMDs. Ask if you've been taking them. If you haven't, ask how to calculate what you owe and how to catch up. Action item 2. If you're over 73, verify your RMD calculations for the last 3 years. Don't assume your brokerage did it right. Don't assume your tax preparer did it right. Check it yourself or hire someone to check it. The IRS has worksheets on their website, Publication 590B. It's dense and confusing, but it has the tables and the formulas, or hire a CPA to review it. $500 to $1,000 for a review is a lot cheaper than a $50,000 penalty. Action item 3. If you've received any IRS notice in the last year, pull it out right now and verify that you responded correctly. If you just paid what they asked without formally responding, that might not count as a response. Call the number on the notice. Ask if there's an open case. Ask if you need to file any additional forms. If you ignored a notice, hoping it would go away, stop hoping. Call immediately. Tell them you received a notice and want to respond. They'll tell you what you need to do. Do it. Action item 4. Set up alerts on all your retirement accounts. Most brokerages let you set up email or text alerts for distributions. balance changes, anything that happens in your account. Turn all of those on. Also, sign up for IRS online access at irs.gov. You need to create an account and verify your identity. It's annoying, but do it. Once you have access, you can see your tax transcripts, see if there are any notices or liens filed against you, see what the IRS thinks you owe. Check it monthly, takes 5 minutes, could save you hundreds of thousands of dollars. Action item 5. If you have 3 or more of the warning signs, pay a specialist to do a comprehensive review. Not next month, this week. Find a CPA or enrolled agent who specializes in retirement accounts. Pay them to review everything, your accounts, your distributions, your tax returns for the last 3 years. It will cost money, $800 to $2,000, depending on how complex your situation is. That's expensive, but it's cheap compared to what Frank is going through. Now let me tell you what happened to me after I took these steps. The forgotten 403B account I found, I called them, told them I hadn't been taking RMDs. They calculated what I should have taken for 2 years. Total was $680. I withdrew it immediately, paid the taxes, called a tax attorney and asked if I needed to file anything about the missed distributions. He said technically I owed a penalty, 50% of what I should have withdrawn. So 50% of $680 is $3 to $40. But there's a process for requesting a waiver of the penalty if you can show reasonable cause. We filed for the waiver, explained that I'd genuinely forgotten about the account, that I'd withdrawn the missed amounts as soon as I discovered the issue, that it was an honest mistake with no intent to avoid taxes. The IRS granted the waiver. I paid the $680 in taxes, no penalty, issue closed. If I'd ignored it, if I'd never found that account, eventually the IRS would have found it. They get reports from all financial institutions. They would have sent me a notice, then another. Then they would have filed a lien, and I'd be fighting them for access to all my retirement accounts, not just that one small 403B, because once they file a lien, they can freeze everything while they sort it out. The error in my RMD calculation that my CPA found, he recalculated what I should have been taking. I'd been underpaying by about $200 a year. Over 2 years, I'd under-withdrawn $400. We withdrew an extra $400 from my IRA, filed an amended return showing the additional income, paid an extra $90 in taxes, no penalty, because we caught it and corrected it before the IRS did. The notice I responded to within 7 days instead of ignoring turned out to be about a $4,800 income discrepancy that was completely wrong. The IRS had counted some interest income twice. I sent them documentation showing the error. They agreed. Case closed in 6 weeks. If I'd ignored it, they would have assessed on $200 in additional taxes plus penalties and interest. Then when I didn't pay, they would have started the lien process, all over their mistake that I would have had to fight while my accounts were frozen. Total cost of being proactive, $850 for the CPA, about 8 hours of my time, $90 in additional taxes from the corrected RMD calculation. Total amount I protected, $470,000 in retirement accounts that could have been frozen if any of these small issues had snowballed. Frank is still fighting, 14 months in. He's proven that most of what the IRS claimed he owed was wrong. He's gotten the amount down from $11,800 to $2,300, but his accounts are still frozen. The IRS doesn't move fast. Even when they admit they're wrong, the process to unfreeze accounts takes months. His lawyer says they'll probably resolve it in the next 3 to 6 months. So Frank will have gone almost 2 years unable to access his retirement money. 2 years at age 74. 2 years of his retirement stolen not by bad investments or market crashes, but by bureaucratic process. And here's the cruelest irony. When this is finally resolved, when his accounts are unfrozen and he gets access to his money again, he'll have lost years of growth. The market has gone up during the time his money was frozen. Other people's retirement accounts grew. His didn't, because frozen accounts can't be traded or rebalanced. He'll also have spent over $20,000 on lawyers and accountants to fight this. Even if he wins, even if he proves he didn't owe what they claimed, he's still out that $20,000 because the IRS doesn't reimburse your legal fees for defending yourself against their mistakes. This is what I'm trying to save you from. I need you to understand something. The government isn't evil. The IRS isn't trying to steal your retirement, but they have systems and rules and procedures, and those systems don't care about your individual situation. They don't care that you're elderly. They don't care that it was an honest mistake. They don't care that you didn't know. The law says if you don't take your RMD, you owe a penalty. The law says if you don't respond to notices, they can file liens. The law says they can freeze your accounts. And they will, because that's what the system does. Your protection isn't hoping they'll be reasonable. Your protection is following the rules precisely and responding to everything immediately. So here's what I need you to do. Check your situation against these 5 warning signs. If you have even one, take action this week. If you have 3 or more, treat this as an emergency. Get professional help. Not your nephew who's good with money. Not your friend who used to work at H&R Block. A real CPA or enrolled agent who specializes in retirement accounts. Create systems to track everything, file every notice, respond to everything. Check your IRS account online monthly. Don't assume your brokerage is calculating things correctly. Don't assume your tax preparer caught everything. Verify. Because here's the reality. You've spent 40 or 50 years building your retirement savings. You've worked, you've sacrificed, you've saved. And all of that can be frozen or seized because of administrative errors, calculation mistakes, or ignored notices. The system doesn't care how hard you worked. It cares whether you followed the procedures. Frank worked for 38 years. Saved $340,000, did everything he thought he was supposed to do, and he's been locked out of his own money for over a year because he ignored 2 letters and missed 1 deadline. Don't be Frank. Check the 5 warning signs. Take action on anything that applies to you. Get professional help. Respond to everything. Your retirement isn't guaranteed. It's not safe just because it's in an account with your name on it. It's vulnerable to administrative actions, tax liens, and bureaucratic processes that don't care about your age or your intentions. Protect it this week, not later, now. Because the worst call you'll ever get is the one telling you your retirement account has been frozen and you can't access your own money. Ask Frank, he'll tell you.